Hello and welcome to NDTV Profit. You're watching IPO Adda, and my company in focus today is Hexaware Technologies. The company is a digital and technology service provider backed by artificial intelligence, and it's coming with coming out with an IPO which opens on Feb 12th and closes on Feb 14th. Price between 674 to 708. It's a OFS of 8,750 crores, and that values the company at little over 43,000 crores at the upper end of the price band. And joining me today is Sri Krishna Ramakarthikeyan, who is the whole-time director, and Vikas Kumar Jain, who is the CFO of the company. Gentlemen, thank you very much for joining us on NDTV Profit. $1 billion IPO coming in 2025. And I would say that it's a comeback to the markets for Hexaware as well after 4 or 5 years. What's the reason for comeback, and how do you see the current IT environment?
The two different questions. As a management team, we are big fans of being a public company. It is great for attracting and retaining the best digital talent in the world, being a public company. It is also very good for customers. They get a lot of comfort in the governance standards that come with being a public company. So we're big fans. We are excited about coming back to being public.
When you filed for your
question.
Yeah, second question.
There's a lot of puts and takes right now that is going after the demand. There is an AI, which is a more secular trend, but then there is a US election cycle and macros that are impacting demand. But I'll say the net of all this, I think we're going to have somewhat improving, slow but steady improving demand environment over the coming quarters.
Sri Krishna, before I go into the financials and operations of the company, when you filed your DRHP, the size of the issue, if I'm not wrong, was little less than 10,000 odd crores, and now you're coming with 8,750 crores. Any reason why you have reduced the size?
Nobody is in a hurry to dilute fully at any. There's a long time available, long time window, so that's mainly the reason.
Or it's entirely a Carlyle decision to reduce the size and the valuation?
Carlyle is the only selling shareholder. So yes, it is their decision.
Give me a sense of your growth trajectory in the last 4 years. We've known Hexaware before 2020 when it delisted. Since 2020, there has been a change in management from Bearings to Carlyle, which happened in 2021, and now till 24. How has been the performance of the company? How have you pivoted across various maybe geographies, functions, and business areas, verticals?
See, what has happened over the last 4 years, and I'll come to numbers in a minute, but we've grown in scale quite a bit. We crossed $1 billion 3 years ago. We've grown substantially in capabilities, leadership changes in some cases, very talented new leaders who helped the organization build great new platforms. In all cases, the platforms are AI infused. The most recent platform, RapidX, is GenAI native born. So increased capabilities, a very systematic capability to acquire new clients. Every month, I know that we will get new clients, even if I go to sleep. What has not changed is the fact that we have the best net promoter score in the industry. Our customers are delighted with the work we do for them. What has not changed is that employees love working for Hexaware, evidence in the highest Glassdoor rating, amongst the lowest attrition in the industry. What all of this is combined then is to give us a solid set of customers with whom we gain market share every week. And so that's what is the why of the growth, and that also gives me confidence about future. So the actual numbers, 3 years, 21 to 23, US dollar terms, we grew 13.7% CAGR, which I think is top 3 in the industry. Last year, 24, calendar 24, 9 months, we grew at 12% over the prior 9-month period. I think that is top 2 in the industry. So we've done very well relative to everyone else.
True. I was looking at your number CAGR of 13%, which is good actually. But can you give us a sense of how your current year going to be? Because we have numbers till September, and after September things have changed for the world. Trump has come in, the policies have changed, outlook has changed, trade policies have changed, I would say. And from a tech point of view, yes, some bit of discretionary spends have come back. There's some good demand which is coming in, or gradual demand which is coming in. How do you see that thing? Because as an IT company or as an investor, they would like to know from you how things have changed for you post October, which is actually your 4th quarter, right?
So I'll talk to the factors, right? Election is the biggest one. So I think what the election meant is this, okay? There is a threat of taxes going back to where they were before 2017. That's gone away. There is a higher expectation that there will be much lower regulation. There will be much lower scrutiny on M&A, and generally a business-friendly environment. So I think all of this is a significant net positive. I'll say the flip side is that broad-based tariffs could be a negative, right? So, depends on how much tariffs, which country, the sectors could vary. But in general, broad-based tariffs is a negative. But net of all this is still a far more positive environment than what it was a few months ago.
Because come in here, margins of 15, core margins of 15 plus percent, you're seeking a multiple of nearly 40 times price to earnings. Is there enough headroom for you to take these margins higher?
I would say this, that if you look into our adjusted margins, while the reported margins are 15.8, our adjusted margins are 17.4, the number that we disclosed in the RHP. And our margins improvement have been actually accelerating in the last 3 years, from 22 onwards. The primary reasons that our margins have been accelerating, it's coming from a lot of the operational rigor that we have put in motion. Our utilizations have improved to close to 82.5. We still think that there is a scope for us to improve it. Some of the players in the industry are operating at 84% odd. Our offshore mix have improved from 41 to 44%. It is still lower than a lot of the players in the industry, so we think we have a headroom to improve there. Our attrition rates have come down. We have expanded our operations in tier 2 locations. In the year 24, those locations are scaling up. So if you look into it, our base margin is close to 17.4. That's the floor, and we hope to continue to work on our operating levers, which should actually help us in future.
When you say base margin is 17.4, you're basically excluding the expenses for any ESOP costs and others, right?
There are primarily one-time adjustments that we have done with respect to expenses incurred on ERP implementation, onerous contracts write-off. So those are the ones which we are adjusting because we don't expect them to continue in future.
Okay. Shri Krishna, give us a sense of the financial services vector vertical which you have, and also from a geographies, Americas. Are you seeing demand coming back from a financial services point of view?
Short answer, yes. Evidence in the fact that the 9-month growth in financial services is amongst the highest in the company. And this is, of course, even prior to the election. I think this is certainly a sector that I think will see the most positive as a consequence of election, lesser regulation, more M&A activity. I think this sector will likely do even better.
When you say that you are an AI-enabled company with support going for every client, is it possible for you to quantify what is the quantum of contracts which are AI-enabled for you?
So what is our vision, right? Our vision is that every single day, every work we do for every client should be touched by AI. Now, to make this happen, we are doing two things. First, we are training and certifying virtually every single tech employee in the company. So right now, about 85%. And this includes me. This includes Vikash, starts really from the top. The second thing we're doing is that every platform of our service lines, the 3 core platforms, they are AI infused. In fact, one of them is built native in the AI era, Tensai. The newest one, RapidX, is built native on GenAI. So when customers use that to consume services, AI is impacting how they receive services on a daily basis. Now, I will say that virtually every single dollar of our pipeline, virtually every single new business we get is influenced by AI.
Is it possible for you to give us what is the kind of TCV that you have done in the 9-month period?
So I personally think that the connection between TCV and revenue growth was always tenuous. It has become even more so in the last several quarters. So we don't think it's a good metric to focus on. In fact, we may be at a situation right now with discretionary demand coming back where TCVs can come down, but growth can improve. Because actually having smaller single-year transformation deals as opposed to multi-year outsourcing deals with larger TCVs. So we don't disclose TCV.
Going forward, when you got to get listed, even then as well, because the industry looks actively on TCVs.
Yeah, even in the past, we actually never disclosed total TCV. We used to talk about new client wins. So yes, even after we are public, we will not be disclosing TCV. And like I said, I think the reason, even though everybody looks at it, I think people have found it really hard to correlate between TCV announced and growth.
So what is the kind of growth outlook that you're projecting to investors, right? Means you don't want to give TCV out, so that doesn't give the street any idea of what kind of order book you're sitting on. But they said you have a CAGR of 13% on top line. Is that the CAGR that you're going to follow for the next couple of quarters or year?
You know, I can't be specific about the future, right?
I'm trying my best.
Our ambition is to do better in future.
Give me a sense of the Trump policy impact on Mexico and Canada. Means you have revenues coming from Mexico and Canada to the tune only 7% of your total revenues. If this tariff goes through, now he has pushed it to by a month. But if this tariff goes through, what is the kind of impact that you have? Because of course there will be a currency impact for sure, but from a business impact point of view, what could be the impact?
So the majority of the revenues actually come from Canada. There's a little bit from Mexico. We have a big footprint in Mexico, but that is for delivering services to customers globally, mainly in the US, but some elsewhere too. So our revenues are mainly from Canada. You know, the impact as they were enacted, if it stays, I think the biggest impact is going to be on automotive, because literally every part of a car moves across the 3 countries multiple times before it rolls out of a dealer. Fortunately or unfortunately for us, we are not exposed to the auto sector. Now, there are some other sectors, you know, beer, we are not exposed to that, that's from Mexico. Petroleum, potentially from Canada, we don't have exposure to that. So I think our exposure will be limited. We have a specific set of clientele in Canada. in financial services, in travel, none of them will be impacted.
But you do see impact on because of the currency, Canadian dollar and peso getting hit because of the dollar. Vikas, will that be one of the issues which will be there for Hexaware, given the fact that you have 7% of your revenues coming from that region?
So I think, as Keech mentioned, that we have a significant amount of delivery presence from a Mexico perspective. We don't do, our rate cards are not decided on the basis of Mexican peso, what we charge to the end client. So from that perspective, as dollar strengthens, at a global level, it is a bit of a headwind from a revenue perspective for the cases where the revenues with the clients are not contracted in US dollar terms. But for the most part, it's limited, but it's a significant amount of benefit from a margins perspective, because we have our cost base primarily in India and even in Mexico, where strengthening of dollar is basically helpful. It creates a tailwind on the margins.
Sri Krishna, two more questions. One on Europe. Europe have been slow in picking up. What is your view on European clients? How are they picking up in terms of discretionary demand, or is it still a few quarters away? And the second one is basically on the attrition rate of 11.3% that you had at the end of Q3. Going into the next year, is there a plan to, what is the kind of plan you have with respect to hiring and hiring outlook that you have?
On Europe, just to zoom out a bit, in the last several years, it has done very well for us, right? The contribution of Europe to our company revenue has gone up from 15 to 22%. This is in spite of a currency headwind on pound and euro on revenue, right? So the long-term outlook on Europe has been very solid. I think there was what I think of as a short-term downturn, and it will come back. Europe is looking better for us, and you can see that in the 9-month performance too was a little bit better, right? Sorry, just tell me the second question again.
The second question on hiring. What is the number of hires that you're looking for in 2025?
Hiring, yes. Yeah. So listen, we again, we can't be specific about forward, but in the last several quarters, we have had the highest net headcount addition in the industry, or amongst the highest net headcount addition in the industry. So right now, Hexaware is a great place to work. In a lot of places around the world, if you want a job and you want to be safe and you want growth and you want great quality work, Hexaware is the best place to apply to.
Gentlemen, we hope to speak to you again in the next few days as you list and as your financial results for calendar year 2024 comes in. All the best for your IPO. Your IPO is opening on Feb 12th, closes on 14th, price between 674 to 708, pricing the company at little over $5 billion or 43,000 crores. It's an OFS for 8,750 crores. Thank you for joining us today on NDTV Profit.